Now we're going to define a business transaction. So a business transaction is any activity that changes the value of a firm's assets, liabilities, or owner's equity. So a business transaction has to have its financial impact has to be reliably measured. If you cannot reliably measure the financial impact of something, then it's not a transaction. For example, if we hire an employee to start the first day of next month, that is not a business transaction because there's no exchange of value. If we set up a credit line with a bank, that's not a transaction because there's no exchange of value. If we pay an attorney a retainer fee for future legal counsel, that is a business transaction because we paid cash for a promise of legal services. So there has to be an exchange of cash or other things of value in order for it to be a business transaction. Here you see some other examples of business transactions. Purchase equipment on credit, cash payment to a creditor, purchase of supplies, or payment of rent. And here are a few more examples. Business transactions have a dual effect on the organization. We've already said that the accounting equation, assets equals liabilities plus owner's equity, must always balance. To maintain that balance, transactions are recorded as having a dual effect on the accounting elements. So if there's a company that purchased $3,000 of equipment on credit, that transaction has two effects on the accounting elements. One, the assets increase because an asset was acquired. And number two, since we purchased that asset on credit, our liabilities also increase. Just like if I owe JCPenney $200 and I go charge something for $50, my liability is going to increase to $250. So the effects of business transactions can be stated in terms of changes in the basic elements of the accounting equation. To determine exactly how the equation is affected, each transaction must be analyzed or broken down to determine how it affects the accounting elements. And there are some transactions that start on page 20 in your book, and you should definitely look over those to make sure that you understand how each of those transactions has the dual effect on the accounting equation. On page 20, it talks about a shift in assets when we exchange one asset for another, like when we spend cash, which is an asset, to buy supplies, which are also an asset. Something else to remember, the cost principle states that when purchased, all assets are recorded at their actual cost, regardless of market value. Some other terms to look at are revenue, and that's income from carrying out the major activity of a firm, and that increases the value of the business. Expenses are costs related to operating a business. Like in a business, paying your power bill would be an expense. Paying your employee's salary would be an expense. Another item is withdrawals, when an owner withdraws business assets for personal use. So revenue always increases owner's equity, expenses always decrease owner's equity, and owner withdrawals always decrease owner's equity. And here you see owner investments always increase owner's equity also.